This is the VOA Special English Economics Report. Energy has become an important issue in the American presidential campaign. And gasoline prices, costs that affect almost all Americans, have risen sharply in recent months. For example, former Massachusetts Governor Mitt Romney has criticized President Obama's energy policy. In a newspaper commentary, he said the president has let prices rise while placing too many requirements on the energy industry. One issue in the political debate is a project proposed by the Canadian company TransCanada. Its Keystone XL pipeline would stretch more than 3,000 kilometers from Alberta, Canada, to several oil processing centers in the United States. If completed, the project would cost about $13 billion and transport over 1 million barrels of oil a day. The Republican Party has criticized President Obama for delaying work on the oil pipeline. Republican Doc Hastings serves in the United States Congress. He says the party wants to use all of the nation's energy resources. Mr. Hastings says that would include use of both the Keystone XL pipeline and oil exploration in coastal waters. He says Republicans in the House of Representatives have passed reforms that break down government barriers to America's natural resources. And he says the House has passed legislation that would open coastal areas to new oil exploration and production. In early March, President Obama visited a Daimler truck factory in North Carolina. He told workers that more oil exploration is not an easy answer to the nation's energy problems. He said the United States has 2% of the world's oil reserves, but uses 20% of the world's oil. He said this means that even with increased oil production, there is no easy answer to high gasoline prices. Workers at the North Carolina factory build alternative fuel vehicles. Mr. Obama told them that new sources of energy mean more jobs. The president has called for tax breaks on clean energy vehicles and urged local governments to buy them. He also has asked lawmakers to end $4 billion in support for the oil and gas industries. For VOA Special English, I'm Carolyn Prasuti. You can download texts and MP3s of our programs and learn English at voaspecialenglish.com.
From VOA Learning English, this is the Economics Report in Special English. European Union countries have struggled to find common ground as they tried to work out a budget agreement in Belgium. But this month, they agreed on the European Union's multi-annual financial framework, or MMF, for the period from 2014 to 2020. The MMF sets the EU's yearly spending at about $1.3 trillion. That is 1% of the income of the EU. Members agreed to reduce total spending by more than 3% for the period. This is the first time that members have accepted cutting costs. European Council President Herman van Rompuy spoke after the agreement was announced. He said the compromise budget might not be perfect, but he said it should help all EU members. German Chancellor Angela Merkel praised the long-term spending plan. She said the agreement makes policy more predictable and enables members to act in Europe's interest. Some EU leaders have been calling for greater spending controls in their home countries. They wanted the EU to show that it too is willing to cut costs. British Prime Minister David Cameron welcomed the agreement. Before the two-day meeting in Brussels, he had threatened to veto the budget if there were no steps toward reducing spending. But the agreement still might not succeed. The European Parliament must approve the measure. And some members of the Parliament say it fails to deal with many problems, like the sharp differences in wealth between rich and poor people. If the measure is approved, it will affect 28 European Union countries. The EU says Croatia is expected to join the group in July. For VOA Learning English,
This is the VOA Special English Economics Report. Leaders of the European Union say they will help Greece as it struggles under a mountain of debt. They promise to take action, if needed, to safeguard financial stability in the euro area as a whole. But the leaders did not announce any detailed plan for Greece after meeting in February in Brussels. They said that was because Greece has not requested any financial support. European Commission President José Manuel Barroso said this means the government believes it does not need the support. Investors had a mixed reaction to the statements from Brussels. Worries over Greek debt have pushed the euro to its lowest value in months against the dollar. European Union finance ministers discussed the situation when they met in the Belgian capital in February. 16 of the 27 nations in the European Union use the euro as their currency. Now, the stronger members are seeking ways to help the weaker ones, like Greece. European Union rules limit the choices for a rescue. The European Central Bank and national central banks are barred from aiding members by purchasing their debt. European officials hope to avoid the crisis that could spread if Greece fails to pay its debts. Greece needs to borrow more than $70 billion this year to finance its budget and refinance its debts. In October, Greece said its budget deficit would reach almost 13% of its gross domestic product last year. GDP is the widest measure of economic activity. Greece represents less than 3% of the euro area economy, but its deficit is around 4 times the level permitted by the euro group. Greece has promised to cut public spending in an effort to reduce its deficit by 4 percentage points this year. And Greece is not the only country in trouble. High levels of public debt in Ireland, Portugal, and Spain are also worrying debt markets. Nations in the euro area share a common currency, but not a common financial policy. This leads to big differences in economic results. Some members have very low levels of public debt. Others have very high levels. Greece's debt could reach 120% of its GDP this year. In February, the European Commission approved a Greek plan to cut government spending. Thousands of public employees in Greece held a strike to protest cost-cutting measures. And that's the VOA Special English
This is the
Economics
VOA
Report.
Special English Economics Report. On November 30th, the European Central Bank took action to support the worldwide financial system. Central banks in Britain, Canada, Japan, Switzerland, and the United States also acted. The banks made it less costly for other countries to borrow American dollars. The United States Federal Reserve said the joint effort was meant to help central banks in Europe provide financial support to nations that need it. The action sent American stock prices up more than 3%. On December 1st, European Central Bank President Mario Draghi suggested that the ECB may provide new financial support for European countries struggling with debt. But first, he said, Euro area countries must establish trust by enacting big financial reforms. He said, a credible signal is needed to give ultimate insurance over the short term. What I believe our economic and monetary union needs is a new fiscal compact, a fundamental restatement of the fiscal rules, together with the mutual fiscal commitments that Euro area governments have made. 17 members of the European Union share the euro currency. Concern over its future has been building in recent years. The Greek debt crisis, rescue loans for Ireland and Portugal, and worries over Italy's debt have all increased fears that Europe may have to abandon the euro. The euro is the world's second most traded and second most used reserve currency after the dollar. European finance ministers failed to agree in November on a plan to provide economic support for debt-troubled countries. Financial officials say a lack of economic and financial cooperation is at the heart of the two-year-old debt crisis. Dutch Finance Minister Jan Kees de Jager said there is a strong need for tougher rules. Lack of economic reforms and lack of fiscal discipline has brought us into this crisis. So you also have to address these fundamental issues. That means Euro nations may have to surrender some power over their budgets to the European Union. For VOA Special English, I'm Carolyn Presutti. We have more programs at voaspecialenglish.com, where people can read, listen, and learn English with texts, MP3s, and activities. We also offer English lessons at the VOA Learning English page. This is the VOA Special English Economics Report. European finance ministers agreed to loan Greece about $172 billion at a meeting in February in Brussels. Luxembourg's Prime Minister, Jean-Claude Juncker, announced the agreement. After a meeting of at least, I think, 13 or 14 hours, we have reached a far-reaching agreement on Greece's new program and private sector involvement that will lead to a very significant debt reduction for Greece. Under the plan, Greece's private creditors will lose more than half of the face value of their investments. The agreement also means the country will receive its second financial rescue in less than 2 years. The new loans will likely let the Greek government make a $19 billion payment on its debt by March 20th. Now, Greece must negotiate the terms of its loans with individual banks and other investors. But these creditors will have to hurry. Greece can dictate its own terms once it reaches agreement with 2/3 of its creditors. Not everyone believes Greece will be able to repay its loans. The Fitch Financial Services Company cut the credit rating of Greece. Fitch said it remains highly likely that the country will fail to meet its financial responsibilities. The Greek Parliament has agreed to the idea of spending and job cuts demanded by the European Union and the International Monetary Fund. The Parliament has to pass all 79 measures included in a reform plan before getting the rescue loans. Prime Minister Loukas Papademos has said his country has a lot of work to do before it can receive new aid. At the same time, protests continue in Greece over budget-cutting measures. Many Greeks say they have sacrificed enough. But Greece's EU neighbors are unlikely to release new loans until the budget cuts are in place. The head of the EU delegation to the United States, Ambassador João Vale de Almeida, told VOA that the Union has learned from the crisis. We learned a lot about the means that we need to have to deal with emergency situations. We didn't have them before. We developed them to deal with the cases like Greece and a few other countries. Secondly, we learned that our governance system was not yet at the right level of sophistication. And we are, in fact, changing a lot. If not, there is a small revolution going on inside the euro area in the way we deal with what we call the economic governance. There is a lot being changed. For VOA Special English,
This is the
I'm
VOA
Carolyn
Special
Prissy.
English Economics Report. Facebook says it aims to raise $5 billion through its first public sale of stock. That would be one of the biggest initial public offerings ever. And it would be much bigger than Google's first public stock sale in 2004. That IPO raised almost $2 billion. The world's biggest social media network filed documents with the Securities and Exchange Commission on February 1st. The documents are required before the company can launch an initial public offering. A date for the sale was not immediately announced. Facebook has more than 800 million users around the world. It represents the second most visited website after Google. Now, experts say the social media company is in a position to become one of the world's most valuable internet companies. Stock expert Anupam Pallett
at Greencrest Capital, says that among social media sites, Facebook is in a class by itself. It's the biggest company in this space, and we believe what makes it very unique from every other company that went public last year in this space is that it is very, very profitable. Early estimates value the social network between $75 and $100 billion. That includes earlier investments by other companies. David Kirkpatrick wrote the book, The Facebook Effect. He says Facebook's IPO will be historic. Will Facebook's IPO be the biggest IPO in American history? Probably not. But it will certainly be by far the biggest internet or technology IPO we've ever seen. The stock sale could also make 27-year-old Facebook co-founder Mark Zuckerberg one of the world's youngest billionaires. Investment companies are likely to be the first to buy the stock. Investment manager Jim O'Shaughnessy points out that the price of some IPO stocks fall not long after they first go on sale. Stock in LinkedIn, Groupon, and Zynga dropped as much as 25% after going public. Many IPOs come out being very, very overvalued because they get so hyped up and investors are so taken in by the story that they're willing to pay any amount just to be able to get into the stock. That generally translates to being very overvalued. So we generally tell investors that they should wait probably a good full year before they look at buying stock that was recently IPO'd. There were similar questions 8 years ago about Google. Today, Google is one of the world's most valuable technology companies. For VOA Special English,
I'm Alex
Carolyn
Villarreal
Presutti.
with the VOA Special English Economics Report. Facebook is the world's biggest social network and the subject of the movie The Social Network. The real Mark Zuckerberg and his friends at Harvard University launched the site in 2004. Facebook says it reached 500 million users last July. Now, the American bank Goldman Sachs and the Russian company Digital Sky Technologies have friended Facebook. They are investing a total of $500 million in the company. The deal values Facebook at $50 billion, more than many publicly traded internet companies. Goldman Sachs is expected to raise $1.5 billion more by selling shares of ownership in Facebook to rich investors. The plan does not include a public stock offering, at least not right now. For now, Facebook would remain a private company, meaning a company that does not sell shares to the public. The plan has brought new attention to the largely secretive world of private financing and the rules for private companies in the United States. The idea is that investors in public companies have protections that investors in private companies do not. The Securities and Exchange Commission says a private company must report financial information if it has more than 500 shareholders. A new business, a startup company, is usually considered too risky for average investors. But a promising startup may find a small number of private investors, often known as angels. These investors are willing to lose everything for a chance at big returns. Ricky Tata has been involved in raising money for startups. He is now chairman of his own investment company, Covestor, with offices in New York and London. Mr. Tata compares the difference between public and private companies to the difference between marriage and dating. When people are dating, he says, there are understandings, but few rules. In marriage, the rules are more clear and well-defined. In his opinion, the only real benefit for a private company is lower administrative and record-keeping costs. Yet, he tells us Covestor remains a private company after a few years because it is still too risky for most investors. For VOA Special English, I'm Alex Villarreal. You can comment on our programs and find transcripts and MP3s at voaspecialenglish.com. We're on Facebook and Twitter at VOA Learning English. VOA Special English Economics Report. Facebook is the world's biggest social network. It has over 900 million users worldwide, and it reported $3.7 billion in sales for last year. The company has been privately held since 2004. That was when Mark Zuckerberg and several classmates at Harvard University started Facebook as a business. But on May 18th, Facebook becomes a publicly traded company. That means its shares will be listed on the NASDAQ stock market and sold to the public. Interest in the stock kept building after Facebook announced details of its initial public offering, or IPO, earlier this year. The IPO will make billionaires of the company's founders, including Mr. Zuckerberg. Eduardo Saverin, a Brazilian-born co-founder, has been strongly criticized for recently giving up his United States citizenship. By doing so, he will avoid a 15% tax on the value of his shares. He now lives in Singapore. Shortly before the trading started, Facebook told the Securities and Exchange Commission that it wanted to increase the number of shares being offered to over 420 million. The company had earlier said it planned to offer 337 million. The starting price was set at $38, also an increase. Some financial experts say Facebook could raise $16 billion, making it one of the biggest IPOs ever. Most of Facebook's revenue comes from online advertising. But the company also says it expects to earn money from fees charged on the sales of virtual goods. These are digital products used in social games, not physical goods. Facebook says it sees important income coming from this new market, which could reach $14 billion by 2016. Not everyone is pleased. General Motors ended its advertising agreement with Facebook just before the stock began trading. The car maker said it did not see results from the millions of dollars it spent on advertising with Facebook. And Facebook has been criticized for some recent business decisions. It offered $1 billion to buy Instagram, an application for sharing photographs. The deal requires government approval and has yet to be finalized. So, is Facebook worth the price of the stock? That will be for investors to decide. For VOA Special English, I'm Alex Villarreal. You can read, listen, and learn English with more business stories at voaspecialenglish.com. I'm Alex Villarreal with the VOA Special English Economics Report. The Federal Reserve calls America's economic recovery disappointingly slow. So the Federal Reserve decided to add $600 billion to the financial system by the middle of next year. To do this, the central bank will buy Treasury securities from dealers. The action is known as quantitative easing. The goal is to reduce long-term interest rates. The hope is to create conditions where businesses will invest more and people will spend more. Buying longer-term Treasury securities will make less government debt available to investors. This will raise the price. As bond prices rise, their rates fall. Long-term securities affect rates on home mortgages and other loans. Lower rates on corporate bonds could lead businesses to invest in more equipment and jobs. Lowering short-term interest rates is the Federal Reserve's main way to get banks to increase lending. But those rates are already near zero. The Fed earlier bought $1.75 trillion of treasuries and other securities. That program ended in March. Fed Chairman Ben Bernanke wrote in the Washington Post, "Easier financial conditions will promote economic growth." But interest rates are already low, and critics say further cuts are unlikely to create much growth. Inflation also is low, so low that some economists worry more about the risk of falling prices and wages. But others say pumping more money into the economy will weaken the value of the dollar. They say it could raise inflation to dangerous levels, and not just in America. Interest rates in the United States and Europe are lower than in Asia and Latin America. As a result, Asian and Latin American economies are already struggling with an overflow of investments. Large flows of capital can raise currency values and make export-based economies less competitive. Several nations are considering limits on capital. The Fed's action in November had been expected, but it came as the heads of 20 leading economies prepared for talks in South Korea. And it came a day after the Republican Party retook control of the House of Representatives from the Democrats. President Obama invited leaders of both parties to meet on November 18th. One immediate issue was what to do with tax cuts that are set to end in December. For VOA Special English, I'm Alex Villarreal. This is the VOA Special English Economics Report. On July 21st, President Obama signed into law the Wall Street Reform and Consumer Protection Act. He said, "These reforms represent the strongest consumer financial protections in history." Together, the changes represent the biggest rewrite of financial rules since the Great Depression. At the heart of the 2,300 pages in the bill are promises to protect average Americans. Congress agreed to create a Consumer Financial Protection Bureau, but the Federal Reserve will pay for it. The central bank will budget about $500 million a year. Travis Plunkett is legislative director of the Consumer Federation of America, a consumer rights group. He says this new independent office will have a lot of responsibility, and that is a good thing. The Bureau will set rules for the marketplace and enforce existing laws. One goal is to keep home buyers from getting bigger loans than they can pay for. But the Bureau will not have power over auto lenders or banks with assets of less than $10 billion. Financial interests spent millions of dollars fighting the bill. The House of Representatives passed its version in December. In July, the Senate voted final approval with the aid of 3 Republican senators. House Minority Leader John Boehner called the financial reform bill ill-conceived. He said, "I think it's going to make credit harder for the American people to get, clearly harder for businesses to get." But President Obama says Wall Street took irresponsible risks that threatened the financial system. Under the new law, banks no longer can own or invest in certain trading operations. The government has new powers to seize failing financial companies. These include businesses that, during the financial crisis, were considered too big to fail. And President Obama says the law does something else. He said, "Finally, because of this law, the American people will never again be asked to foot the bill for Wall Street's mistakes. There will be no more tax-funded bailouts." Regulatory agencies will write hundreds of new rules for banks and other financial companies. This follows years of deregulation. Opponents in Congress say they will try to block some measures in the new law. But even if those efforts fail, it is too soon to know just how strong the new rules will be. And that's the VOA Special English Economics Report.